Hey, welcome back to the channel. Today we're going to be checking out Murphy USA, ticker symbol MUSA. All right, getting into the 5-year chart, we can see it's been on a nice steady uptrend over the last 5 years, currently sitting on a gain of 291.47% over the past 5 years. It looks like we've got a 52-week low of about 231, 52-week high of about 323. Current PE, according to Google, is about 11.56, and really our probably 5-year lows are around probably that $70 mark, with a 5-year high of 323. So let's go ahead and jump into the investor presentation. All right, so here we have the investor presentation from a conference in 2023. If you guys don't know what Murphy USA is, it's basically a gas station and convenience stores. So let's see what we can find. All right, and through this investor presentation, it keeps on referencing the 2013 spin, and I'm assuming that's spinoff. Googled it real quick, and yes, in 2013, they did do a spinoff of, it looks like their retail marketing business. So it looks like they spun off the U.S. retail marketing business in about 2013, and the investor presentation is pretty much post 2013 performance and kind of their strategy after the spinoff and what they've been able to execute on. And here we can see kind of some of the details of their performance since that spinoff. Obviously, ridiculously good investment returns as a shareholder of 620% over the spinoff period until now, compared to the SPY and the Russell, which is significantly lower. Just an EBITDA since 2018, nice growth there, and some highlights of just the results they had in 2022 and kind of the business model after the spin off, kind of changing a little bit of the business model. So past decade, proof points, 500 new stores to the network, raise and rebuilds 177 stores. That's basically refreshes, I believe. Acquired food and beverage capabilities through targeted M&A. So we'll kind of see through this presentation how they allocate their capital, their thoughts on their capital allocation, investment in the business, and return to shareholders. And then we can see since the spinoff that they've reduced their share count by about 53%, and we'll see those in the financials. Just the massive amount of buybacks that they have been doing over the last decade. Over the next decade, it looks like they are targeting 40 to 50 new stores per annum. So some of their kind of just goals in growth for the business over the next decade, low leverage price position to drive further share gains from growing, customer segment seeking affordability. And you guys can read the rest of this if you want to. It will be posted in the description. Let's see what else we can find. Here they kind of note the cycle of the marginal convenience store retailer, kind of going this like ongoing cycle. Basically, good times, bad times, good times. It's kind of interesting because it seems like they have been able to kind of create a fairly steady margin environment and sales environment through these different cycles compared to potentially some others. And we'll kind of go through that later on. They do note inflation and wage increases driving up OPEX, cost structure up 9 cents since 2007. Lower inflation rate does not lower costs, rather simply reduces rate of cost increases. Compared to a wide range of street prices, the fuel CPG pass through to consumers is modest. As such, volume margin trade-off preserves profitability in the short term. Long term, this inevitable cycle of retail format evolution separates the winners and the losers. And they kind of note that the performance gap is widening between like the higher and the lower players. So basically, when I look at them, it's all about driving efficiencies and operating efficiencies and efficiencies on the acquisition and the turnaround of the commodity that they're in. So gas, right? If you're able to essentially buy and turn that around and sell it at a quicker rate, you basically have less risk of price fluctuation during that, and you can kind of have more stable margins going forward the quicker that you turn that around. If you're waiting a long time to turn around your commodity that you're buying, you have more risk with price fluctuation. So basically, if they can keep that efficient, their margins might change a little bit, but most of that cost increase or decrease is going to be passed through to the consumer. Here we can kind of see their previous unit growth by year, 2019, 2020, 2021, 2022, and 2023 estimates. So they are continuing to grow at a pretty decent pace. And if they do meet those longer term objectives, what was it, about 40 to 50 new stores per year? So they're still growing at a decent pace. And that growth is returning a pretty dang good ROIC. Currently, they've got about 3.8 million active loyalty members, and we'll see later on in the presentation, maybe we'll just go to it right now, that they've kind of been customizing, it looks like, their digital experience to really target what customers would value as far as the targeted ads or targeted deals that they get pushed. So I'm not sure exactly what they're doing on the end, but they're probably doing some type of, heavy data science analytics to be able to push deals towards customers that have a higher take rate by specifically like looking at the customer behavior in the past and going from there. So really, if they can keep their costs consistent on the, acquiring of the commodity, the pass-through, turning it around, selling it quick, and keep those margins consistent, then they have really good sell-through on their merchandising side, energy drinks, whatever, cigarettes, all that stuff. That's going to be where a decent amount of their sales and their profits come from. And here we can see that their merchandising sales are 7% higher versus network average while they're still ramping up. So it looks like, all of the numbers are looking pretty good. Forward looking estimates of their network square feet, 2022, 23, 24, 25, 26, 27. So it looks like they're going from about 2.1 million square feet to about 3 million square feet. So probably around 45, 47, 50% growth over that 2, 3, 5 year period. And then they also give us some targets, some financial targets for the 5-year period as well, along with repurchasing a ridiculous amount of shares, 33% of the float since 2019. So let's go find those 5-year targets. And here we can see raising the bar again, 5-year view. They're targeting EBITDA of around 1.2 million. Share count decreased from 21.7 million to 17.7 million. So that's going to be a decent, 12% decrease, something like that. Multiple 9 to 10. They're hoping to get a 10, but you know what? The market will decide that. So we'll see. But if they continue to grow at this rate, hit those numbers, and just devour their share count, it could be very, very, very interesting. 2023 guidance up to 45 new stores, raise and rebuilds up to 30, so refreshes on 30, up to 45 new. Merchandising contribution about 795 to 815. Rate fuel volume, so increasing volume. So increasing to flat volume. We got retail station OpEx. 32 to 34 from 31, so a little bit of increase there. Capital allocation, 375 to 425 on the capital expenditures, so a decent amount of reinvestment there. And then we can also see their 2027 targets again of net income of 623, income tax 210, interest expense, so we get a good breakdown of what they're really trying to target over the next 5 years as far as their growth, their buybacks, their ending share count after 5 years, and the net income and the EBITDA that they're targeting. So that will give us some good numbers to go off of when we do the evaluation. And that's it's coming up next. We'll get into the financials. All right, so real quick, let's just go through the financials. We can kind of see their bottom line growing over the last several years, especially, and then their margins, operating gross margins, free cash flow, net margins, kind of had some decent margin expansion in 2020, and then a pulled back, but pretty stable. Long term, they've kind of been able to increase those margins at a pretty decent rate. Bottom line yields on the valuation, all over the place, but typically probably looking at around 8%, 7 to 8% on the valuation side. And then we get into those beautiful buybacks and that amazingly decreasing float. So they went from 46.86 million shares to 22.13. And when you do that, this is what happens. You get some nice share price growth just off of the decrease in the share count alone. So and I'm fine with that. If they're buying back shares and their equity is rated at an 8% yield, then sweet. That's a really low valuation. They're able to take a decent amount of shares off the table that are really yielding a pretty decent amount. All right, so we have here we have the income statement. You can see just the growth over time, kind of moderated and grew a little bit over the last couple of years. We can see the operating expenses growth. It looks like there might have been some recharacterization of SG&A along with operating expenses that happened in about 2020. So you have to look into that more to find out more details. But then we see the EPS growth from the beautiful share buybacks that they've been doing. So even though for a time period, their bottom line incomes were relatively flat total, because they were doing so much buybacks, they had a nice increase in EPS. All right, and then going on to the balance sheet stats, we see the total assets, short-term, long-term liabilities, and cash and short-term investments. Long-term debt shot up right here, so we might need to keep an eye on that. Maybe look at their leverage ratios compared to their operating cash flow to make sure they're keeping those ratios kind of in check as they grow. We don't want the leverage ratio increasing as they're operating or as they're growing out. We want to kind of see a nice steady path where they're keeping their leverage in check. Getting over to the free cash flow statement, we can see operating cash flow growing over the last decade or so. Stock-based compensation is a little bit, not too bad, depreciating a decent amount. And then we can see massive amount of common stock repurchase. So most of their free cash flow is going to some debt repayment, but not a ton. And really, most of their debt is probably capital lease, long-term capital lease. So if we go over to the balance sheet, we can see that, capital lease obligations. So we'd have to dig into that a little bit more, but they are, of course, shifting a lot of that free cash flow into CapEx, further growth, and a ton of common stock repurchases. Going over to ratios and metrics, you can see they just started kind of doing a dividend and then also raising that dividend on a nice steady basis. Their dividend payout ratio is 7% right now, so very low, really low dividend payout ratio. So they have plenty of room to grow that, and just growing it from the decrease in share count. If they continue to repurchase, 5% of their stock, that's going to help a lot. Capital return on equity, 14, 28%, ROCE, 5%, return on assets, 2%. So per share metrics, yep, decent per share metric growth when compared to like net income growth, just because of the amount of buybacks. So common stock repurchase, you can see they did a ton in 2022. And then this sheet is labeled REIT metrics, but it's got some metrics that I want to see, kind of comparing operating cash flow, net income, and the dividends paid. So obviously we can see that's a very, very, very low dividend amount compared to their net income, operating cash flow, long-term debt, operating cash flow, debt repayment. But the thing that I'm really interested in is total debt compared to their operating cash flow. As they levered up, it looked like, and took on more debt. That might have just been capital lease obligations, I'm not sure, but so as they took on more debt, they have been growing that operating cash flow pretty well. And then we look at their leverage as far as their cash flow coverage ratios when it comes to interest expenses versus the operating cash flow that they have. And it's really good. So operating cash flow is growing at a very nice clip, and their interest expenses remain pretty low, so their leverage ratios are looking pretty dang good still. And with that being said, let's go ahead and jump on into the valuation. Now the valuation is going to be kind of interesting because we have to, I'm going to go off of net income that they guided in 2027. That's about 4 years out, but I have a 5-year template. So the net income is supposed to be around 670 million. Which is pretty much flat from where it is today. But what we got to realize is that they're going to be doing so much CapEx growth. So much of of that growth is going to be essentially written off as a depreciation and amortization of the assets for the new stores occurs over the next 4 or 5 years. So their EBITDA is going to grow while their net income is going to pretty much remain neutral off of a 2022 basis. So it's kind of interesting. If we go into the net income or the net yield bottom lines over the last 10 years, we can see it's kind of fluctuated between probably right around like, I don't know, 7%, 8%, 8.52 to 6. So we could probably say that, like, you know what, best case, maybe the yield at the end of the 4 or 5 year period on a net yield basis is maybe like 5% in the best case scenario, 5.5% in the best case scenario, with maybe 9% in the worst case scenario. Because most likely, if that does play out and they're depreciating a high amount of assets, their operating cash flow is going to be way better than necessarily their net cash flow on a net basis. All right, so on the valuation side, what I'm doing here is I am normalizing and then going off of net income only for the valuation. We have average yield spread, actually not average yield spread, but future estimated yield for the multiple of 5.44 in the very bullish scenario and 8.28 in the very bearish scenario. And then I tweaked these dilution amounts and the growth to essentially line up management's guidance in the 5 year period to our base case. So we can see that we're sitting right around like 600 to 633 on years 4 and 5 on net income. And then we are doing a share buybacks in about 5.06%, which gets us right between that 17.98 and 17.07 ending share count. So the base case is essentially what management is kind of guiding for, and we're targeting, in this case, a 15% CAGR with a 2.5% margin of safety, which is a 17.5% target rate and a 0.46% dividend yield. I'm actually going to change that a little bit. I'm going to do 14.5 because I just want total return to be about 17.5% after our margin of safety. So 14.5, there we go, easy peasy. And on the yield multiple basis, we can see, 5.5 would be pretty bullish right around here. And then that 8-9 area would probably be historically, the midpoint. So, I mean, this is one where if they do trade super, super cheap, and they have really good cash flows, the price will be lower, but they'll probably be buying back shares, so they'll be buying back a greater amount, which could help us out long term as long as the business is stable long term. So with all of these scenarios, we can kind of see the different 5 year cases. The very bearish scenario, they essentially don't even hit 600 million in net income. The bear scenario is right at 6. Base case is basically guidance. And then our bullish scenarios are upwards towards about 700 net at the end of the 5 year period with a little bit better buybacks. When we get into the 5 year targets, basically it gives us a very bearish buy price of 170, a bearish buy price of 204, a base case buy price of 249, a bullish buy price of 310, which we are right there, and a very bullish buy price of 393. But this is assuming a pretty decent 17.5% annual CAGR. In the 5 year scenarios for the final price, if these were theoretical cases were to play out, we would have about a $380 buy price in the very bearish scenario, a $456 in the bearish, a $556 in the base, 691 in the bullish, and an 876 in the very bullish. But it's hard to tell like how much multiple expansion we could potentially get on a net income basis if they were doing a decent amount of depreciation and amortization and growing at a decent rate. So I'm actually kind of surprised that their 5 year target's that low on the net side, because that's basically, they hit that in net income, they hit that in 2022. So they're almost like, it's strange that they're almost like projecting no net income growth, but I guess it kind of makes sense because they're just focusing on so much capital reinvestment, and maybe they're trying to, keep their competitive advantage as a very low cost provider. So they're going to prioritize tighter margins, lower net growth to keep their customer base. So yeah, that's looking interesting. If we wanted to change the CAGR amount to say 12.5%, so a little bit over 15, or actually 12%, so about 15% total target CAGR after our margin of safety. We get a little bit closer. Our base case is about 283, buy point, bearish is 232, very bearish is 193, bullish is 352, and very bullish is 447. That's what I got for you guys. Hope you've had a great week, and we'll catch you in the next one. As always, this is not financial advice. This is just my musings and looking over another company. So do your own research, your own valuation, everything, and do not buy or sell or do anything based off of a guy, on YouTube ever. Please don't do it. Just don't.